Next, we are going to see about the last class we discussed about the advantages payback period. Now we are going to discuss about the disadvantages of payback period. So disadvantages of payback. It takes no account of the timing of cash flow. Received today is a worth of then 100 received in the 12 months time. It is only concerned with how quickly the initial investment is recovered, and thus it ignores the overall profitability and return on capital for the whole project. Time value of money. The time value of money concept plays an important role in appraising capital project because of the time lagging between the initial investment and payback can be quite long. $1 was spent sooner, it was more than one earning or spent later. To evaluate any project taking into the account the time value of money, the cash flow received in the future must be reduced or discounted to a present value so that all the relevant cash flow are dominated. It involves the present value. The cost of capital. All investment projects require funding. Generally, funding can be classified into equity funding, debt. Equity funding, where investors buy an equity or ownership share in a project. This is done through the issue of shares or retaining the profit in the business. Debt, where the company can borrow or issue its own debenture. Each sources of finance has a cost. The cost of debt is the interest rate that applies to the debt. The cost of equity finance can be divided and increase in shares price expected by shareholders. This cost of capital becomes a benchmark or minimum required return on a project. A project is only truly profitable when it is an acquiring the asset is greater than the company's. Example, the cost of capital. Grab Limo Service Limited has invested 1,50,000 in two second-hand limousines. This investment has a financial through the bank loan of 9%. In this first year, the car generates 60,000 in revenue and 40,000 in operating profit. It includes the wages, cleaning, petrol, insurance, advertising, and depreciation. Is the business generating a return greater than the cost of capital? Ignoring the corporate tax, the project achieved an operating profit of 20,000 and hence the return of investment is given 13.33%. This is greater than the cost of capital of 9% and thus the project is truly profitable. Weighted average cost of capital. If the project is funded by more than one method of financing, the weighted average cost of capital should be calculated. Loan finance, equity finance. Under loan finance, that 1 lakh at 9%, equity finance 50,000 at 12%. Discounted cash flow. DCF in the investment appraisal technique that takes account of the time value of money. It looks the cash flow of a project, not the accounting profit. It is concerned with liquidity, not profitability. The time of cash flow is taken into the account by discounting all future cash flow at present value. The effect of discounting is to give greater value per euro or cash flow acquired earlier. The discount factor to use in the cost of capital of a business. Next, net present value. Net present value can be defined as the cash equivalent of the sum of money can be received or paid to the stated future date discounted to the specific cost of capital. The net present value is the value obtained by discounting all cash outflow and inflow of the capital investment project at a chosen target rate of return of cost or cost of capital. The present value of cash inflow minimizes the present value of cash outflow is called the present value. If the present value is positive, it means that the cash inflow from the investment will yield a return in excess of the cost of capital and thus the project should be undertaken as long as there is no other project offering this higher EPV. Net present value is negative, it means that the cash inflow from the investment yield a return below the cost of capital and so the project would not be undertaken. If net present value is exactly zero, the cash inflow from the investment will yield a return which is exactly the same as the cost of capital and thus may be not a worthy undertaking depend upon the investment opportunities available in the organization. Thank you.